Without further ado, please give a huge welcome to the stage for Mr. Andrew Dimitri.
Thanks, guys. How are you all doing? Good? As Megan said, my name's Andrew Dimitri. I'm the founder and manager and probably head trader of a small but proud little company by the name of Planet Wealth. So listen, I want to thank all you guys for being here today. It's a Monday afternoon. You almost made it. Almost there. How's it been? Good weekend? Yeah. You got you learnt plenty? Yeah. Yep. You got room in your head for a bit more? Yep. Okay. Just jam it down a bit, like a rubbish bin. Swish it down. We're just going to put a little bit more on top. So I'm going to tell you today a little bit about, or everything about, one of the strategies that we use to create wealth and ongoing income from using options in the stock market. So I know you guys have learnt quite a lot about, this weekend about options, trading options for income, renting shares, but using options for protection. I'm going to put together something that we've used over the last decade or so, about 12 years, to create income, which has pretty much been able to fund my lifestyle. Mine and my wife's and some friends of ours' lifestyle has been funded by this strategy. Okay, so this is a real life strategy that we use, that I've been using for a long time, and I'm going to teach you guys everything we know about it. Okay, so I'm going to show you how it works, and how you can use it to start making money pretty well almost straight away. I'm going to show you how we can help you to do that as well with very little time on your own. Okay? So, what I notice when I come to these seminars and I talk to people is that everybody wants something slightly different. Everyone's got a different goal or a different thoughts on what they're trying to achieve. Some of you might want to earn enough income to quit your jobs, to retire. Anyone in that sort of boat would like to replace their wage? That was pretty much my driving force. When I was a graduate, as Megan said, just like you guys, about 11, 12 years ago, I was sitting in the seat there, looking up. It was a little bit less organised than it is now. It was pretty much Jamie up here talking about his life experiences, and we learned a lot from that. But we pretty much had to then work out our own, what we were going to do. And we put together this strategy based on what I learned from this seminar and lots of other seminars as well. So my driving force at the time wasn't trying to be a millionaire. My driving force was I had a pretty good job. My wife had a good job. She was a bank manager. We were earning reasonably good money. The problem was that we had no time. Okay, we're working 60, 70 hours a week, very little time for a lifestyle. So what we wanted to do was replace our wage. Okay, earn income on a regular basis, weekly if we could, monthly if we can, to replace our wage so we can live the lifestyle we want without having to work for it. Okay, so if any of you go out there who are looking to learn to replace your income on a regular basis, then this could be a perfect strategy for you. There might be some of you out there who aren't worried too much about working, you don't mind going to work, but just want to increase your wealth a little bit, just get a bit of extra wealth creation. You might want to buy a new car, go on holidays, buy new clothes, that sort of thing. So if you want to do that, just to get a little bit of extra income, you can do this as well. Some of you might love your jobs. Anyone out there who loves their job so much that they wouldn't quit even if they had lots of money? Handful of you? Well, look, guys, that is awesome, because that is, I suppose, the definition of happiness, when you can do what you love doing every day and get paid for it. But for those of you who aren't quite in that situation, wouldn't it be great if you could earn enough money elsewhere so that you could, every day of your life, do something you love doing? Wouldn't that be awesome? So that's why, again, another way we can use this strategy. If you're looking to do that, then this strategy may be perfect for you again. And finally, there's a lot of people I find who, for whatever reason, don't even want to do anything with shares. How many of you guys who have been here this weekend or even before you came and thinking you're not going to do anything with shares at all, you're just going to do property? Anyone in that boat here now? None? Excellent. One of you? Okay. Well, look, it's great to hear that, because a lot of people get pigeonholed into certain investment strategies. And I do a lot of property myself. But what we do is that we use this strategy to fund our property investments. Okay? And property, just by its nature, often takes a lot more time. Okay? It can take months for settlements and contracts and all that sort of thing. It can take a long period of time. So it's normally large chunks of money, every few months, or if you can settle up like that, even once a year or whatever it may be. But in the meantime, you've got to fund your lifestyle, right? So we use this strategy to fund our lifestyle and then use that money to fund other investments like property, business, and both commercial and residential property as well. So, whether you're looking to replace your income or you just want a bit of extra wealth, or you love your job, you want to be able to just fund your lifestyle while you're working like that, or even if you love property, but I really encourage you to use shares. Any of those things, we believe this strategy is one of the few that will work for just about all of those situations. Okay, we can obviously trade the strategy in any market direction, up, sideways or down. We can make money from this strategy, so you can use it for all market conditions. But, you know, as I said, everybody's a little bit different. Different people want different things. Each of you have a different thing that makes you, maybe provides you with happiness or fulfillment or satisfaction, and everyone's a little bit different. I just want to show you a very quick little video that I found that sort of portrays that. Just gives you an idea of what I'm talking about as far as different people for different things. And I'll just play this video, and this will just give you an idea about exactly what I'm talking about.
En dan komen we hier bij de slaapkamer.
Oh ja.
Met...
So different strokes for different folks, right? I'm personally more of a fan of the walk-in beer fridge myself. I don't know about you guys. So the idea is that different things make people happy and give them their wants in life. And what we think is with this strategy, it's something that can provide for just about every situation, no matter what you're looking for. Okay, and I think that video sort of shows that pretty well. So I'm going to show you how you can start, how we trade the strategy, how you guys can start doing it, and how you can start earning money literally within days. Okay, I think it's pretty important that when you walk out of here, you've got something you can get your teeth stuck into straight away and start getting income within a few days. Okay, I'm going to show you how you can do it automatically, how we do it, and how you can copy what we do. And one thing I just want to point out before I start is that how many people have seen, obviously there's been some great speakers up here this weekend, right? Some great presentations, some really good strategies. How many of you guys have seen something you really love and already signed up for a program that you're going to put some attention to? Okay. So for those of you, what I find a lot of people think is that they've chosen one situation and they're happy they're going to stick with that. What I want to show, and hopefully I can show you this today, is that this strategy is complementary to just about every other strategy you'll do. We invest, just about every strategy you've seen people up here talking about it, I invest in that myself. Okay, in one form or another, myself and Planet Wealth use the strategies you've seen up here. All the shares and all the property and styles, that's what we do ourselves. And we use this strategy which funds and brings them all together. Okay, so just because you're committed to something else, I want you to keep in mind that you can still do this as well. Okay, I'm going to show you how you can do that a little bit later on. All right? So, okay, with that, let's get started. I've only got a short period up here today, so I'm not going to waste too much time. I'm going to get stuck straight into it. I see a lot of you got your pads and papers out. I'm going to give you a lot of content here today. Okay, so I'm going to give you a real strategy, the way we use it, so make sure you make plenty of notes. There's going to be time for questions after as well, so I'll give you time to ask questions. And so hopefully I'll run through everything and you have a pretty good understanding when you leave here of exactly what we do, why we do it, and how it can help you guys. Okay, so first of all, Planet Wealth, what we do is we are authorised to provide general financial advice under a financial services licence. The reason I just want to let you guys know this is that the bottom line there, we're authorised to provide general financial advice only. The reason I say that is because I don't know you guys personally. Okay, I know there are some familiar faces in the room. Hopefully I get to know you all a little bit more, but I don't know your current situation. I don't know how much money you've got. I don't know what your risk profile is. So I can't tell you that this is perfect for you. All I'm up here to do today is show you what we do, and then you guys have to make the decision whether it's going to be right for you. Okay? And through that you can seek your financial advice, your advisor, your accountant, whoever that may be. But just be aware that all I'm showing up here is what we do, and then you guys make the decision whether that makes sense to you and whether you think you can make it work as well. So what we do at Planet Wealth is we use 6 different strategies. As I said to you, the strategy I'm going to talk to you about today is option spreads, which is that red one there. But we do other strategies, and that's complemented by the option spread strategy to create income. So we do a thing called share purchase plans, which is, who's heard of lots of money raising capital in the last couple of years? Okay? Heaps of people heaps of companies are raising money. We can actually partake in those capital raisings and get shares at a discount and basically sell them for full price on the market. So that's one strategy we use, very easy, very low risk. Renting shares, both Australia and US, we do renting shares. You guys are pretty familiar with renting shares up to this weekend? Yep, okay. So we do it slightly different where we always have protection on our shares at all times, so we don't get caught by any big market drops like the last few years. So we do that in both Australia and the US, obviously slightly different markets, but they works great in both countries. Protected equity, which is pretty much buying protection and then buying shares longer term. You might have heard Daniel talking about something similar where he buys a put option and buys a CFD in the underlying. So we do that same sort of thing with shares on the Australian market, which is a great way for longer term wealth. option spreads, and of course active options, which is a much more aggressive directional option trading in the US markets only. Okay, so I'm going to talk about option spreads. I wanted to show you that just to give you an idea about what we do. As I said, this strategy is complementary to other strategies as well. So if you are doing something else or planning on doing something else going forward, option spreads are still a perfect thing that complements it. All right, so trading option spreads, let's get stuck into it. I know you guys are probably reasonably familiar with this. Probably you've had probably over the weekend you've had a good foundation in option spreads. How do people talk about spreads so far? A little bit? Okay. So I'm going to tie that together and show you exactly how we do it. But I think that's good that you guys have a good foundation, because then I can spend a bit of time on some more important stuff with trading that not many people talk about, which is things like how to manage, how to work out your trade sizes, how to work out portfolio risk, how to manage a portfolio in total. Because these are things that aren't that sexy to talk about. You know, having someone up here talking about great returns and seeing big dollar numbers gets you quite excited. But we don't talk about the details too much. So I'm going to talk a little bit about real life trading, because I know you guys have already got a good foundation of what I'm going to in the actual strategy itself. So there are 4 different types of spreads, and they can be used in any direction. Okay, share price over any given time can do what? What direction can the share price move? Up, down or sideways. So if the share price can go up, sideways or down, what we do is we simply choose the spread, the type of spread, depending on which direction we think it's going to go. So we can go either neutral to bullish, in which case we do a credit put spread or a debit call spread, or we can go neutral to bearish, which covers this region, and do a debit put spread or a credit call spread. Now, don't worry, don't let those names get confused to start with. What we're going to talk about today is a credit put spread. I haven't got time to talk about all 4, of course, but I can tell you that they're almost identical. All they do is use different options in different direction. So once you learn one, you learn all 4 of them. Okay? So I'm going to teach you one today called the credit put spread. And then what we also do is we teach all this, which I'll talk about later on, in a series of ebooks. So we're going to give everyone the ability to get those ebooks free of charge, which I'll talk a little bit about later on as well. Okay, so the credit put spread, which is often called selling insurance on the stock market. So when we talk about insurance on the stock market, what are we talking about? Put options, exactly right. So why do people want insurance? Protection, that's right, to protect their shares or protect their investment. And the more and more savvy, the more and more educated people are getting about investing, the more and more they're understanding they need protection. Okay, I would never buy shares in any strategy without having protection. So even when we do a renting shares portfolio, for instance, we have protection on every trade we do. We're never naked. So if people want insurance, and more and more people want insurance, let's be the one to sell it to them. Who thinks insurance companies are good businesses? Make good money? They make hundreds of millions, billions of dollars. So what we do is we just become like an insurance company. If you want life insurance or car insurance or house insurance, basically the insurance company sells you that insurance and you pay them a premium. And we do exactly the same thing. So we become the insurance company, and selling insurance is basically selling a promise. As I'm sure you know, if you're selling a car, if you're insuring your car for 20 grand, what the insurance company is really doing is just making you a promise that if you crash that car, they'll pay you the $20,000, right? And for that, you pay them a premium. So they take a risk and you pay them to cover that risk, and pay them a premium. So we do the same thing on the stock market. We make a promise that we'll buy certain shares at a certain price on or before an agreed date. Okay, that's all we're doing. We're making a promise, and for that we're getting paid a premium. So let's look at a real trade. The best way that I can explain this to you guys is to actually use a real trade. I've changed the name of the company to XYZ, but these numbers I'm going to give you are based on a real life trade that we've done in the past. Okay? And it's not a special trade, it's not a higher returning trade, I'm going to show you that, but this is like an average trade. In fact, it's even a little bit on the low side. So what we do is XYZ is currently at $19.67. Oh, that's my thing. What we're going to do is we're going to sell insurance at a price slightly below that at $19.50. Okay? So what we're doing is we're making a promise that we're going to buy those shares at $19.50. And for that promise, the person who buys our insurance is going to pay us 45 cents per share. We're going to do that over a 5-week period. Normally, our insurance contracts go for a period of 3 to 6 weeks. So 5 weeks. We normally try and do them every month. So normally about 4 weeks. This one we're going to do over a 5-week period. And we're going to assume, just for this example, that we've got 20 grand. Okay, you've got 20 grand burning a hole in your pocket that you're going to invest on this one trade. Okay? So the first thing we do, once we choose where we're going to sell insurance and how much we're going to receive, first thing we want to do, and this goes for any investment, is work out our risk. The risk, of course, is how much you can lose, right? What's the worst case scenario in the stock market? Sure. Price goes all the way down from 1967 down to zero. If that happens, in this scenario, what's our risk? $19.50. We've made a promise to buy those shares at $19.50. Even if they go down to zero, we've still got to buy them at $19.50. So our risk is $19.50. Of course, as you guys already know, options are done, when we sell insurance, we sell them in lots of 1,000 shares. Yep, on the Australian market it's 1,000 shares. On the US it's 100. So in 1,000 shares for Australian. So our premium is not 45 cents, our premium is $450. And our risk is not $19.50 per share, it's $19,050. And you may go, hang on a minute, he just said it's $19.50 per share. 1,000 shares is $19,500. But when you crash your car and you make a claim, does the insurance money give you your premium back? No? The insurance company keeps the premium you've already paid them, don't they? So their risk is the $19,500 minus the premium we've already received, because that's already in our pocket. So our risk is $19,050 for our 1,000 shares. Everyone follow that? So even if the stock market, even if this price goes to zero, the most we can lose is $19,050. That's our risk. Okay, so what we want to then do is work out our return on risk. You know, it's all about returns. How much money are we making? So our return, we want to work out as $450. Our risk is $19,050. Simply divide the return by the risk and you get 2.3%. And you can do this on your calculator just to make sure my numbers are correct, but that works out at 2.3% for that trade. How does 2.3% sound? Pretty crappy, isn't it? But remember, that's over 5 weeks. So what we then do with all investments, if we're doing them for less than a year, is we make them annualised. We need to compare this to other investments, right? The only way we know this is going to be any good is if we can compare it to putting money in the bank or buying a property or whatever it may be. So to compare investments, the reality is you need to do it on an annualised basis. When you get money in the bank, you don't get 6% every 5 weeks, you get 6% per year. So we annualise our returns. That doesn't mean we're going to get exactly the same trade every 5 weeks and exactly the same return. It means that we can it's an information process where we can see how much we're getting. If we did that every 5 weeks for the year and we got $450, how much would our return be? So to annualise a trade, all you need to do is work out the return for the time period, which is 2.3%. Then you divide it by the number of days. We're doing it for 5 weeks, so it's 35 days. 2.3 divided by 35, that will give you a per day return. To make it a year, times it by 365. And that gives you an annualised return. That goes for any investment you're doing. If you're doing any trade over 2 weeks, 6 weeks, 3 months, you can divide it by the number of days, times it by 365, and that gives you a per annum return. In this case, works out at 24%. That's a bit better, isn't it? Not bad. But this is what we call naked put options, which means we're standing there without any clothes on. We've got no protection. And this is far too much risk. Far too much risk for the return. This is pretty good. We can get $450 for every trade we do, but if we're risking almost 20 grand, eventually one of these trades is going to fall over. Who's heard of HOH? Babcock and Brown. You know, some of these companies that were $30, $40 are now zero, don't exist anymore. So that can happen. If that goes down to zero, then all of a sudden you've lost your $20,000, $19,000, $50 in one go. And all the 30 trades you've done before, which have made you $400, is gone like that, and you get wiped out. So we don't do this. Don't you love the way that I just spent 10 minutes telling you what we don't do? I do that because I want to show you, I want you to understand more about why we do what we do. So what do we really do? What does an insurance company really do? We're talking about insurance company before. When an insurance company insures your car and insures your house and insures your life and insures your boats, they put it all together and they have one big book of risk. They call it an insurance book. And it might be $1 billion for everybody's, all their risks put together. What they then go and do is they go and insure themselves. Who knows what that's called when an insurance company insures themselves? Reinsurance, that's right. So what it means is that they might have $1 billion risk, but if something happens, if there's an earthquake or a tidal wave or something, they've got most of that risk is already insured, and they'll only have to come up with a small amount of it. And that's what makes insurance companies such good business models, because they insure themselves. So just like a real insurance company, we insure ourselves. What we do is we pay a portion of our profits to insure ourselves so that our risk is much smaller. Let's see how that works. So the same trade, we had XYZ was at $19.67. We sold a put option at $19.50 and we received 45 cents. This time we buy a put option at a lower price at $18.50 and for that we pay 6 cents. So what's our premium? How much do we get in our pocket? 39 cents. Now again, we're doing it in lots of 1,000 shares, so our actual premium is $390 per contract. Everyone follow that? Okay. So now we've set that up, that's our trade. The next question we ask ourselves is, what's our risk? So again, stock market, price comes crashing down, XYZ goes down to zero. What's our risk? What's our worst case scenario? We've made a promise to buy the shares at $19.50, but someone else has made us a promise to buy our shares at $18.50. So we've insured almost all of our risk. We did have a risk of $19.50. We've insured $18.50 of that risk. So the most we can lose is $1. For 1,000 shares, $1,000. But again, we get to keep that premium. That premium, this $390, that's already in our pocket. That's in our bank account.